Hi everyone, I wanted to spend a few minutes talking about some of the highlights of Chapter 3 as you were continuing your study. So Chapter 3 is job order costing, cost flows, and external reporting. Our first learning objective in Chapter 3 is to really understand the flow of costs in that job order costing system and also come up with some journal entries to record the accumulation and assignment of those costs. And then learning objective 2, we also want to use our T accounts that we talked about in Principles of Financial Accounting to show how the flow of costs in a job order costing system operate, like how they move. A couple of definitions that are mostly review here. Raw materials are any materials that go into the products we're producing, and this certainly constitutes both direct and indirect materials from a cost classification standpoint. So we'll worry about separating those in just a few minutes here. Work in process, as the name implies, are any units of product that are partly done but not quite finished and not ready to sell. Finished goods, on the other hand, are units of product that are finished and are ready to sell, just haven't been sold yet. And then cost of goods manufactured, we can think of that as really being the cost of goods finished in a particular period. So if we look at a nice little diagram here of the flow of costs in our job order costing system, we have our product and period costs on the left-hand side here, and none of these particular things are permanent accounts, right? So raw materials purchases is really a temporary account. Direct labor or factory labor is a temporary account, as is manufacturing overhead. And then our selling and admin costs, we probably have expense accounts for those from a T account or ledger standpoint, but the point is they're not permanent either. In the middle, we have some balance sheet accounts that accumulate some of those costs though. Raw materials inventory is a permanent account, and that's going to accumulate all of our raw materials purchases costs in a particular period. Work in process, again, is going to track the costs associated with any products that we're currently working on and not quite finished with. So that's why we see arrows from direct labor and manufacturing overhead, and also from raw materials inventory. So we're really assigning overhead to this work in process account as we apply that overhead to particular jobs. We're also assigning labor costs to work in process, and we're assigning or moving materials costs to work in process as well as we're continuing to work on those jobs. We also have finished goods inventory on the balance sheet. Again, that's the costs associated with any products that are finished and ready to sell. And as we see, there's really just one arrow going into finished goods. We're always moving the cost of goods from work in process to finished goods, and really that mimics the flow of the physical goods in our warehouse. So if you think about it in terms of people working on things in a factory, as we're tinkering on those products and trying to finish them up, all the costs associated with them are sitting in work in process. As we finish those products, all the costs and the goods that go with them, so to speak, move to the finished goods inventory pile. On the far right hand side, we have our income statement. And the point to make here is that the costs associated with the products we're selling only hit the income statement when goods are actually sold. So the costs associated with those goods that are being sold move at that point from finished goods to cost of goods sold. And we'll look at that in the T accounts in a minute. Then again, our period costs are selling and admin. Those are being expensed right to the income statement. They're not flowing through the balance sheet. Okay, they're not inventoriable costs if we think about our Chapter 2 definitions. So to illustrate the cost flows, we're going to follow a short example here. We're going to look at Ruger Corporation's transactions for this month of April. They're making gold and silver medallions, and they only worked on a couple jobs in April. So job A is a special minting of 1,000 gold medallions commemorating the invention of some motion pictures. It started during March, finished in April. As of March 31st, job A had been assigned $30,000 in manufacturing costs, which corresponds with the work in process balance we see on April 1st of $30,000. Again, any costs associated with jobs that are not finished as of a particular end of a period are going to be sitting in work in process if we look at the balance sheet. Job B for Ruger is a separate order of different medallions that was started in April and was incomplete at the end of the month. So again, there's going to be things sitting in work in process at the end of April associated with this particular job. Let's suppose that on April 1st, Ruger had $7,000 in raw materials, and that during the month the company purchased on account an extra $60,000 in raw materials. We would book a journal entry that looks just like this here. A debit to raw materials, that's an asset account, right? So we're increasing it with a debit, and a credit to accounts payable. We looked at similar things in our Principles of Financial class, right? This is nothing really new other than to know that it's associated with this production process and our overall job costing system. Yeah, so let's suppose during April, materials requisition forms were prepared to authorize withdrawing $52,000 in raw materials from the storeroom for use in production. Those raw materials consist of $50,000 for direct materials and $2,000 of which are considered indirect materials. So when we record a journal entry to represent that requisition, we need to make sure we're differentiating between those direct and indirect materials. Direct materials get debited directly to work in process, so a debit for $50,000, and then the $2,000 in indirect materials get debited to manufacturing overhead. So again, manufacturing overhead should be accumulating all of our manufacturing overhead costs in terms of indirect materials, indirect labor, and other, and then we'll worry about assigning overhead to our jobs in just a minute. We finish off that entry with a credit to raw materials for $52,000, again to represent the fact that the materials pile is dropping by a total of $52,000. Again, $50,000 of which are considered direct, $2,000 are considered indirect. So if we look at our T accounts, we can see how these costs kind of flow in our system already. Raw materials here, again, we're debiting that for any purchases we're making to increase that account. We're crediting it for the use of any materials within the production process. Our direct materials need to flow from raw materials to work in process. We saw that in the journal entry a minute ago. And then our indirect materials, the costs associated with those, is flowing from raw materials to manufacturing overhead. And we might as well highlight real quick that again, if we look at our overhead account, actual overhead costs are hitting the debit side. Applied overhead costs are represented with credits from the overhead account. And we'll do some more with that when we actually apply some overhead in a minute. So let's record some labor cost. So here for Ruger in April, our employee payroll records include $60,000 in direct labor and $15,000 in indirect labor. So we would book a journal entry like the following. Again, we're debiting work in process for the direct labor. Direct costs always go directly to work in process. We're also debiting manufacturing overhead for $15,000 for that indirect labor. Indirect costs have to hit the overhead account, and then we'll later apply those to work in process on the basis of how much of our allocation base each particular job is using during the period. So we're finishing this entry with a credit to salaries and wages payable for $75,000. And now we can look at the flow of those costs from a T account perspective. So again, salary and wages payable, we're crediting for both direct and indirect labor. Direct labor gets debited directly to work in process. Indirect labor, again, has to hit our manufacturing overhead account, at least temporarily. We're going to apply those overhead costs to work in process coming up again in just a minute. So recording some more actual manufacturing overhead costs. Let's assume Ruger incurs a whole bunch of general factory costs here in April, $21,000 in utilities, $16,000 in rent, and then $3,000 in miscellaneous. So the sum of those is $40,000. So we're going to make a summary entry to debit manufacturing overhead for $40,000 and credit accounts payable for that same 40,000. Okay? We might also have cash, some other kind of note payable if we were doing anything with interest on a loan related to equipment. Could have almost an infinite number of accounts on the credit side here. But for now, our important point is that the overhead account is being debited for this total of all the overhead costs. Again, overhead always debited for the actual costs incurred, credited for the amounts we're applying to work in process. So let's look at the flow of that overhead cost summary here. Again, we're just debiting the overhead account for these other overhead costs. And in this case, we don't have anything else in terms of our cost flow to worry about. Okay, just accumulating some more overhead costs. Now let's apply some overhead to work in process. So let's assume that Ruger's predetermined overhead rate is $6 per machine hour. We're also going to assume that during April, 10,000 hours were worked on job A, 5,000 were worked on job B, so a total of 15,000 hours. Therefore, we have $90,000 in overhead cost, 6 times 15,000, to be applied to work in process. So we would record one entry to indicate that application of overhead. So debit to work in process for 90,000. Again, we need to move the costs associated with overhead for these jobs to work in process. So debit work in process 90,000. A credit to manufacturing overhead for that same 90,000. Again, we're trying to represent the flow of overhead costs from their accumulation in the manufacturing overhead account to work in process for the jobs that are being worked on. If we look at the T accounts, we can see that pictorially. Again, manufacturing overhead, we're crediting for the overhead applied. And then in our work in process account, we'd see a debit for that same amount. One other thing to note here, and we'll revisit this in a moment, if actual and applied overhead aren't the same, so if our debits don't equal our credits in the overhead account here, we're going to have under or over applied overhead, and we'll have to adjust that at period end. So accounting for non-manufacturing costs, or our period costs, we do in very much the same way we would have in accounting 120. So we're just expensing those in the period they're incurred. So some of our examples that we've seen in Chapter 3 of those types of costs are things like salaries for folks who are not involved in production, so marketing, selling, admin, anyone in the corporate office, anything like that. And then also things like advertising expenses. So a quick example of some of those. Let's say our company here, Ruger, incurred $30,000 in selling and admin costs. We don't know about the breakout, but we'll just worry about a summary entry. So we would book something like entry 6 here, just a debit to salaries expense, and then a credit to either salaries and wages payable, or if we were paying those in the same period, we may see a credit to cash instead. And then if we had depreciation on office equipment, so things that are, again, not involved in our manufacturing process, we would see a debit to depreciation expense and then a credit to accumulated depreciation. Remember, if we have a depreciation on factory equipment, we would see a debit here instead to the manufacturing overhead account because those costs would be considered part of our manufacturing costs. Let's assume we have one more non-manufacturing cost here, advertising of $42,000 and then other S&A of $8,000. So again, a similar entry here for number 8. A debit advertising expense for that $42,000, a debit for the other S&A for $8,000, and then a credit to accounts payable or cash or however we're clearing those expenses. Again, these types of expenses hit the income statement directly. Right? They're not inventoriable costs, so they don't flow through our inventory accounts. Now, let's assume for Ruger here, job A was completed during April, and then again, job B was still incomplete at the end of the month. So to indicate that job A has moved from the work in process to the finished goods pile, so to speak, we would record an entry as it appears here for entry number 9. So we debit or increase finished goods for $158,000. That's the total cost of job A. And we'd credit work in process or decrease work in process by the same $158,000. Again, the flow of costs in our costing system here is really mimicking or following the flow of physical goods in our production process. As we're finishing things, they're becoming complete, we're moving their costs from work in process to finished goods, again indicating that those goods are finished and ready to sell. And we can see that pictorially in our T accounts. So again, that's a credit to work in process for anything that's finished, and a debit to finished goods for that same amount. And really, in our schedule of cost of goods manufactured that we'll visit in a moment, that's really what we're trying to come up with in terms of that bottom line on that schedule. So what's the cost of goods manufactured, aka the cost of goods finished in the current period? We'll always see a journal entry on the credit side in work in process and on the debit side in finished goods for the amount of cost of goods manufactured for that period. So let's go back to Ruger here for a minute. Because job B was not complete by the end of this particular month, we have its assigned cost still sitting in work in process and moving over to the next month. So if a balance sheet were prepared at the end of April, we just want to note here that the cost accumulated for job B, the $72,000, would appear in that work in process account on the debit side. Again, work in process is an inventory account, which is an asset account. So we'd see that reflected on the balance sheet. Let's assume for Ruger that 750 of the 1,000 medallions in job A were shipped to customers by the end of April here, and total sales revenue of $225,000. So because 1,000 units were made and the total cost was $158,000, we can say that unit product cost was $158. So we would record the following entries to account for the sale of those 750 medallions. We would record a debit to accounts receivable for $225,000 and a credit to sales for $225,000. And then we want to update our inventory records. And this assumes we're using a perpetual inventory system if we think back to our principles of financial accounting. So we would debit cost of goods sold for $118,500. That's the $158 times the 750 gold medallions we sold. And then we'd credit finished goods for that same $118,500. Again, we're following the flow of costs associated with those medallions that have been sold from finished goods out through cost of goods sold. So just a kind of recap here, we're saying all of the costs associated with our production process that flow through inventory, they only hit the income statement when those items are actually sold at this point right here. Otherwise, they're sitting in work in process, finished goods, and so on. So again, we'll look at our T accounts to show that. We have a credit here to finished goods, for that cost of goods sold amount. And then we're seeing that debit in cost of goods sold. Learning objective 3 for chapter 3 was to prepare schedules of cost of goods manufactured and cost of goods sold, and then an income statement. So our schedules of cost of goods manufactured and our cost of goods sold contain 3 types of costs: direct materials, direct labor, and manufacturing overhead. Our product costs, aka manufacturing costs, aka inventoriable costs, right? All those costs that flow through inventory. So the schedule of cost of goods manufactured includes the cost of raw material and direct labor used in production and the amount of overhead that we've applied to production, not necessarily the amount that we've incurred, right? Those two things can be different. And really the bottom line of the cost of goods manufactured schedule is to come up with the costs associated with goods that were finished during the period. So anytime we think of a schedule of cost of goods manufactured, we can think of it as a schedule of cost of goods finished. The cost of goods manufactured, we then add to beginning finished goods to come up with cost of goods available for sale. And then the ending finished goods can be taken from that subtotal to arrive at cost of goods sold. So in other words, what did we start with that was finished and ready to sell? What did we add to it in the period? And then what's left over? The difference between that would be what we must have sold in the current period. And we can think of the same thing in terms of our work in process reconciliation on the schedule of cost of goods manufactured. So what did we start with that was partly done? What did we add to it from a manufacturing cost standpoint in the period? That's our total work in process for the period. Then if we deduct from that our ending work in process inventory, stuff that still isn't finished, the difference will be the cost of goods that we finished in that period. Again, same thing for our finished goods reconciliation when it comes to coming up with cost of goods sold. What did we start with that was done and ready to sell? What did we add to it in terms of what we finished this period? The sum of those is our cost of goods available for sale. If we deduct what was left over, right, that was finished but not sold at the end of the period, the difference is what we must have sold in the current period. And I'll pop up a quick example here of our schedule of cost of goods manufactured and our schedule of cost of goods sold, just to kind of highlight this point again. So schedule of cost of goods manufactured, again, just focus on that very last word, the M, the manufactured. So those only include our manufacturing costs. Direct materials used, direct labor used, and then manufacturing overhead applied. Those three together are our total manufacturing costs. If we add to that our beginning work in process, we'll get a total cost of work in process for the period. If we subtract what was still not finished at the end of the period, that will leave us with our cost of goods manufactured, or again, our cost of goods finished in the period. We can move that, so to speak, to our schedule of cost of goods sold. So we'll start with our beginning finished goods. Again, if we add our cost of goods manufactured from a moment ago, we'll come up with our cost of goods available for sale. So what did I start with that was done and ready to sell? What did I add to it for my cost of goods manufactured schedule? Again, that's cost of goods available for sale. If I deduct my ending finished goods, or what was still not sold at the end of the period, I come up with my cost of goods sold. Now I included a line here for over-applied or under-applied overhead. We do need to account for that at some point, so we'll talk about that in just a minute. Speaking of which, learning objective 4 was to calculate under-applied or over-applied overhead and then prepare a journal entry to close that balance to the appropriate accounts. So just a reminder that manufacturing overhead is a temporary account, clearing account. So at the end of the period, we don't want any balance in there. So that's where this notion of under-applied or over-applied overhead comes in. So the difference between the overhead cost we've applied to work in process and the actual overhead cost that we've incurred is going to be either our under-applied or over-applied overhead. Remember, on the debit side of our manufacturing overhead cost account are the costs we've accumulated for manufacturing overhead. On the credit side are the costs we've applied. Okay. So under-applied overhead exists when we have not applied everything that we've accumulated. So in other words, if we've accumulated more debits in our manufacturing overhead account than we've applied in credits, we've got under-applied overhead. Similarly, over-applied overhead exists when we've got more credits in that overhead account than we do debits. So we've applied more than we've accumulated. So if we think of a quick example here, let's assume Perco's actual overhead for the year was $650,000 with a total of 170,000 labor hours worked on jobs. Perco's predetermined overhead rate's $4 per direct labor hour. So to come up with overhead applied during the period, and we looked at this in Chapter 2, it's just our predetermined overhead rate times our actual activity. So in this case, it's the $4 per direct labor hour rate times 170,000 direct labor hours for a total of $680,000. So what we're comparing to come up with over or under applied overhead is the actual overhead of 650,000 versus applied overhead of 680. So already we can see that we're over applied, right? We've applied more than we actually incurred, so we must be over applied. Okay. And this last bullet point here just summarizes that. So the 680,000 versus the 650,000, we're over applied by 30,000. We have to clear that credit balance in the manufacturing overhead account out at the end of the period. So any balance that's left over in overhead is dumped in one of two ways. So we can close it to cost of goods sold. That's the less accurate but easier and more convenient way. Or we can close it out proportionally to work in process, finished goods, and cost of goods sold on the basis of how much overhead has been applied to those accounts in the current period. So if we're closing it out to cost of goods sold, again, that's the nice quick and dirty way, right? Here we had 30,000 in over applied overhead. So that's sitting on the credit side of the overhead account, right? More credits than debits. So all we would do to close that is debit manufacturing overhead for $30,000 and credit cost of goods sold for the same $30,000. Now note, if we're crediting an expense account like cost of goods sold, we're reducing that account, right? So we're reducing cost of goods sold for the current period here. If we're allocating underapplied or overapplied overhead to work in process, finished goods, and cost of goods sold, again, we want to do that on the basis of how much applied overhead is sitting in those counts for the current period on a proportional basis. So for our purposes here, let's assume that the overhead applied in those accounts was 68,000 in work in process, 204,000 in finished goods, and 408,000 in cost of goods sold. Again, to total that 680,000 from our previous slide. So in this case, the allocation percentage we would use would be calculated as such. So ending work in process, again, 68,000 in applied overhead was sitting there. So 68,000 divided by our total of 680,000 is 10%. Similar idea for finished goods, 204,000 in applied overhead divided by the 680,000 total applied overhead is 30%. And then cost of goods sold, 408,000 in applied overhead divided by the 680,000 in total applied overhead, or 60%. So now we'll allocate the 30,000 in over applied overhead to those three accounts. So for work in process, again, that proportion was 10%. Finished goods was 30%, and cost of goods sold was 60%. So when we multiply those portions by our $30,000 of over applied overhead, we find that we would need to allocate $3,000 to work in process, $9,000, 30% to finished goods, and then $18,000 or 60% to cost of goods sold. Just make sure we kind of double check and have allocated 100% of our over applied or under applied overhead. And then our journal entry is pretty similar to our other disposition entry. Again, we're debiting manufacturing overhead for $30,000. We want to make sure we get overhead back to zero, so to speak, close it out. And then we had our credits, as we calculated a moment ago, $3,000 to work in process, $9,000 to finished goods, and $18,000 to cost of goods sold. Again, credits here are reducing these accounts, right, because we had over-applied overhead in the current period. So just to wrap this up, again, there are two methods for disposing of this under-applied or over-applied overhead. First one was what I always call quick and dirty. Just close it out directly to cost of goods sold. So we only have two accounts affected there, overhead and cost of goods sold. Or we can allocate it, as we did a minute ago, between work in process, finished goods, and cost of goods sold. And again, the second of those methods is considered, more accurate, quote unquote, better, but it is a little more complex. So it's not uncommon to see some companies use that first one, particularly if they believe that it doesn't paint a more accurate costing picture to allocate it between those other accounts. So this kind of wraps up the high-level discussion of Chapter 3. As always, if you have questions, please make sure you ask those in our discussion forum or send me an email or any other method that we've talked about. Thank you.